Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, today we're diving into a really powerful idea from Kirk Northington's work, and it's this. In today's markets, the old rule books, they're basically useless. The game has been totally rewritten, and if you want to win, you have to learn to see the invisible forces that are now calling all the shots.
It's a fantastic question, right? That's what trading feels like it should be. You put money in, you get more money out. But let's be real, the reality is a whole lot tougher. Trading isn't an ATM. It's a zero-sum game. For you to make $1,000, somebody, somewhere, has to lose $1,000. So the very first step to winning is knowing exactly who you're fighting.
And that leads us to the first massive challenge facing every single individual trader out there. It really is a classic David versus Goliath story, but honestly, the odds are even more stacked than you probably think.
I mean, just look at the difference in firepower here. On one side, you've got us, the individual trader, with our off-the-shelf software and public info. And on the other side, you've got these massive institutions with their own custom-built algorithms, high-speed data feeds you can't even buy, and literal armies of PhDs. Northington puts it perfectly. It's like bringing a butter knife to a gunfight.
And believe me, that is not an exaggeration. Check out the kind of brain power they're hiring. These are from actual job postings for the quants at big firms. They want PhDs in math and physics, people who are experts in things like stochastic processes, and they're paying them over $300 grand to start. These folks are not just drawing trend lines on a chart.
And it's not just the brain power, it's the horsepower too. They have supercomputers that can process 100,000 transactions a second. They can execute a trade on a news story in the milliseconds it takes for that story to even load on your screen. So the conclusion here is pretty simple. You cannot beat them at their own game.
But here's the thing. The competition isn't the only problem. The entire structure of the market, the very ground beneath our feet, has fundamentally shifted. And that makes a lot of classic trading strategies pretty much obsolete.
And you don't have to take my word for it. Just look at these two charts. They both cover the same time period, from 2002 to 2007. The one on the left, that's the trading volume for the big Dow Jones stocks. See how it's basically flat? Now look at the chart on the right. That is the volume for options contracts. It's an absolute explosion.
We are talking about an increase of nearly 200%. This isn't just a small change. This is a seismic shift. It means the big money, the players who actually move the market, they're not just trading stocks anymore. They're executing their huge strategies through options, and that changes everything.
So if options are the new vehicle driving the market, what's the engine? Well, the answer is this invisible force that most retail traders completely ignore. It's called volatility.
So what exactly is volatility? Well, the simple way to think about it is as a measure of how wildly a stock's price swings back and forth. It's not about which direction it's going, up or down, it's about the size of the moves. And that number, that measurement, is the single most important ingredient in pricing an option. It is the mathematical heartbeat of the modern market.
And here's the kicker. All those traditional indicators, moving averages, trend lines, they're basically blind to this stuff. As Northington says here, classic analysis shows you what your eyes can see on a chart. But to compete today, you need to see what the microprocessors see. You have to be able to see the volatility.
Okay, so that's the setup. We're outgunned, and the game itself has changed. So, what do? Well, the solution starts with a simple, but really profound, shift in how you think about the market.
You know, most traders see volatility and they immediately think risk. They see a stormy ocean and they run for the shore. But the profitable way to see it is to flip that completely on its head. That storm isn't the risk, it's the opportunity. Those big waves are the raw energy that you can actually use to profit in this new market.
And this leads to a whole new core belief system. You stop looking for nice, calm, average moves in the middle. You start to understand that in a market driven by volatility, the real money is made at the extremes. Your entire job becomes identifying and then exploiting those extreme moments.
So what does this actually look like on a chart? Check this out. Those curved bands you see are calculated using nothing but volatility. Now notice how they project these key price levels, those dashed lines, weeks before the price ever gets there. And look at how the price bounces right off those levels, again and again. This isn't some kind of magic, it's just the math of the market's hidden structure.
All right, so how do we actually use this?
Well, Northington lays out a whole new toolkit with indicators designed specifically to measure volatility and give you an edge by, well, letting you see what other traders simply can't.
For instance, let's take the 2008 market crash. On this chart of the S&P 500, those little skull and crossbones symbols are volatility-based warning signals. And notice where they pop up, right before each massive drop, giving a clear heads up to either get out of the way or maybe get ready to go short.
What's really cool is this can also help you find opportunities where traditional analysis sees absolutely nothing. On these two charts, there's no obvious trend, right? It's just choppy. But the volatility signals correctly predicted a huge upward move for the stock on the left and a big downward move for the one on the right. A typical trend follower would have completely missed both of these.
And finally, this might be one of the most practical uses of all, optimizing your exits. I mean, let's face it, your exits are where you actually win or lose a trade. These signals, which are generated by changes in volatility, can pinpoint these high-probability moments to take your profits, which can dramatically improve your bottom line over time.
So when you put it all together, it's clear we're in a new battleground. It's dominated by institutions, it's driven by options, and you just can't win using the same old tools. The key to not just surviving but actually succeeding is to stop trading the obvious price on the chart and start trading the invisible forces moving underneath it.
Which brings us to the one question that really matters. Faced with this new reality, with all these challenges, with the overwhelming firepower of the competition, how on earth can an individual trader possibly win?
The answer is you don't fight them on their terms. You don't try to be faster or smarter in the old-fashioned way. Instead, you learn to see the very same underlying force that they are trading. You learn to measure, to understand, and to harness volatility. You learn to trade the invisible.
All right, let's get right into it. Today, we're going to talk about the raw, unfiltered truth of the trading world. We're pulling back the curtain to show you who or what you're really up against every single time you hit that buy or sell button.
You've seen the ads, right? Trading is sold to us as this kind of personal magical ATM. You put your money in, you make a few smart clicks, maybe check the news, and presto, you walk away with more than you started with. I mean, it's a super tempting picture, this idea of a direct line to financial freedom.
But here's the thing about that magical ATM. It doesn't just print free money. For every single dollar you make, somebody else has to lose it. So the real question isn't just how do I trade, it's who am I trading against? Where is that money actually coming from?
And that question leads us straight to the fundamental nature of the market. See, it's not this big, happy, cooperative venture. It's a direct competition. It's what's known as a zero-sum game.
Now, the concept is simple, but man, it's brutal. For every winner, there has to be a loser. In a short-term trade, the market doesn't create new wealth out of thin air. No, it just moves it from one person's account to another.
So let's just be really clear about this. Trading is a battle. Your goal isn't just to be right about where a stock is going. Your real objective is to actively take money from the person on the other side of that trade. It's a pretty stark reality, but, getting your head around that is the very first step to actually being able to compete.
Okay, so if it's a battle, let's talk about your opponent. And spoiler alert, it's not just some other guy sitting at his kitchen table. First up, let's talk about brain power.
See, this isn't just about drawing a few lines on a chart and hoping you get lucky. It's a strategic game where you are literally pitted against thousands of other minds all at the same time. The catch? You can't see them. You have no idea what their strategies are. You're basically fighting blind.
And the minds you're up against, well, they're not exactly average. The people on the other side of your trades are often some of the best, the brightest, the most brilliant minds on the planet. We're talking about a level of intellectual horsepower that is just staggering.
And just look at this. This isn't a joke. This is a real job description. They want PhDs in math, physics, computer science, deep knowledge of stochastic processes, partial differential equations. Oh, and you have to be an expert in C++ programming. These are the people building the algorithms that you're trading against every day.
And this quote just hits the nail on the head. I mean, is it really possible that these massive firms are paying millions of dollars to PhDs from MIT just to draw the same trend lines and use the same indicators that you can get for free online? Of course not. They are playing a completely different game, one that's based on math that could probably rival NASA's.
And it's not just their brains, it's the tools they're using. The technology gap between them and us is just as wide. It creates a whole new level of competition.
The big institutional players, they have an infrastructure that we can't even begin to imagine. We're talking about supercomputers crunching data 24/7. Data feeds that process information so fast it's almost incomprehensible. And they have direct physical lines to the exchanges that let them execute trades in milliseconds. Their algorithms aren't just predicting the market, in a way, they're creating it, reacting to patterns before they're even visible to the human eye.
So you think you can trade the news? Well, here's how they do it. A story hits the wire. Before a human can even process it, their software reads it and figures out its market impact in less time than it takes you to blink. An algorithm then places a trade. The whole thing takes about 1 to 3 seconds. By the time you've finished reading the headline, they've already made their profit and are probably selling to the people just now reacting.
So let's just call it what it is. When you're sitting at home with your laptop and your standard internet connection, and they've got this kind of arsenal, it's not just an unfair fight. It's like you're bringing a butter knife to a laser battle.
But look, the biggest challenge you face, it isn't the PhDs and it's not the supercomputers. It's actually something much, much more fundamental than that.
Over the last couple of decades, the entire underlying game of the market has shifted, and it's like most retail traders were just never sent the memo. The whole way that institutions think about and move money has fundamentally changed. And these two charts show it perfectly. So on the left, you see the Dow Jones Index rising pretty steadily between 2002 and 2007. But look at that black line. The actual volume of stocks being traded, it's totally flat. Now look at the chart on the right. During that exact same time, options trading volume absolutely exploded. The big money, you see, they're not just buying and selling stocks anymore. And here are the numbers to prove it. Between 2002 and 2007, stock trading volume growth was, well, basically zero. But options trading volume? That grew by nearly 200%. The smart money, the institutional giants, they moved their game to options.
So what does all this mean? It means the main language of the modern market isn't just price anymore, it's volatility. The entire pricing model for options is based almost completely on volatility. The complex risk models these huge funds use, they're based on volatility. So if you're only looking at price charts, you're not even speaking the right language anymore.
Okay, I know. That all sounds pretty intimidating, right? It sounds like a totally hopeless battle. But it's not. Wrong. Because while Goliath has all this strength, they also have huge weaknesses. And as a small retail trader, you have a very unique advantage.
The best way to think about it is this. The big institutions are like giant freighters. They're moving billions of dollars, which means it can take them weeks just to get into or out of a single position without crashing the market. But you're a speedboat. You're nimble. You can zip in and out of a trade in seconds. And you can profit from tiny little market inefficiencies that they are just way too big to even notice.
And that, right there, is the key. You are not going to win by playing their game. You can't outspend them. You can't outcompute them. But your agility, your ability to be quick and responsive, that is a powerful weapon that they simply do not have.
The real question then becomes, how do you actually use that speed? How do you find those little opportunities that the giant freighters are too slow to see and, frankly, too big to even fit into?
You do it by learning to speak their language. By understanding and analyzing volatility, you can start to see the market the way they do. You can use that knowledge, combine it with your natural speed, and find and exploit all those profitable little gaps they leave behind. And that is how you compete.
All right, let's talk about volatility. When you hear that word, what's the first thing that comes to mind? For most traders, it's just one thing, risk, right? But what if that's completely the wrong way to look at it? I mean, what if the very thing that everyone tells you to be afraid of is actually your single greatest opportunity as a trader? Well, that's exactly what we're going to break down today. How to flip the script and turn volatility from a threat into your most powerful weapon.
Okay, so to really get this, we've got to start with a huge shift in how we see things. It really all comes down to your perspective and what you're trained to look for.
So picture this. An average person looks at a mountain, and what do they see? Probably fear, danger, the risk of falling. But a trained mountaineer, they look at the exact same mountain and see something totally different. They see hazards, sure, but they also see puzzles to be solved. And crucially, they see a path to the top. It's the same object, but their perspective, their training, creates a completely different reality.
And that brings us right into the world of finance. Volatility has gotten a really bum rap. We almost always talk about it like it's a bad thing, something you need to avoid at all costs. But just like that mountain, it's all about perspective. At its very core, volatility isn't good or bad. It's just a measurement. It's simply how much the price is changing. That's it. So, this is the key. You have to adapt a whole new belief system, the one that successful traders live by. And here it is. This is the mindset. Instead of running away from the big price swings, the extremes, you learn to run towards them. Why? Because that's where the real money is made. Now, that all sounds great in theory, but it immediately brings up this huge, kind of scary question that, let's be honest, every single one of us individual traders has to ask ourselves. I mean, let's be real for a second. You're sitting at home and you're up against these institutional giants with entire armies of analysts, supercomputers, and algorithms that can fire off trades faster than you can even blink. So the question is, how in the world do you even begin to compete with that? How do you stand a chance? And the answer, believe it or not, is actually pretty simple. You don't. You just don't play their game. Trying to beat them at their own game of speed or inside info, well, that's a losing battle before you even start. The real way to think about this comes from military strategy, of all places. Back in World War II, the U.S. forces in the Pacific were at first seriously outmatched. So what did they do? They didn't try to attack every single fortified island head-on. No way. They used a strategy called island hopping. They just bypassed the enemy strongholds and only picked fights on strategic islands where they had the advantage. You got to do the same thing in the market. So what's our version of island hopping? Well, your advantage isn't a faster computer or some secret tip. Your great equalizer, the battlefield that you choose to fight on, is volatility. And why is that? Because think about it. Companies can lie about earnings, but no one can hide the price of a stock and when that price moves. It's the one pure, undeniable truth in the market. Okay, so how do we actually use this to get an edge? Well, it's all about creating your own tools that let you see things that almost everyone else is completely blind to. Okay, so this is where it gets really cool, where the rubber meets the road. Take a look at the left. You've got these two individual stock charts, and they're a mess, right? They're noisy, the signals are all over the place. Honestly, you'd probably just skip this trade altogether. But now, look at the right. We took those same two stocks and created a composite chart based on their combined volatility. And just look at what happens. All that chaos on the left suddenly becomes this beautiful, clear, smooth upward trend. See that clean break above the resistance line? That's not just a signal. That's a precise, high-confidence entry point you would have totally missed otherwise. So why on earth does this work so well? It's because when you combine related stocks and analyze their shared volatility, you just filter out a ton of that random, meaningless market noise. This gives you these incredibly sharp, timely signals without that annoying lag you always get with old-school tools like moving averages. It literally lets you see hidden momentum and makes key support and resistance levels just jump right off the screen. And look, this isn't just about one nifty trick with a chart. This is about building a whole new toolkit that lets you spot opportunities and dangers that are basically invisible to the rest of the market. Now, check this out. This is a real-world, high-stakes example. This is the S&P 500, right smack in the middle of the 2008 financial crisis. For most people, that was just a gut-wrenching, catastrophic time of loss. But for traders who are using a volatility-based system, well, look at this. These little skull and crossbones signals, they're basically specific patterns showing a sudden, violent explosion in volatility were crystal clear early warnings. They screamed get out or even go short. This system literally turned one of the biggest financial crises of our lifetime into an incredible money-making opportunity. So what do you get with this new toolkit? Well, for starters, you get a powerful early warning system for market crashes. You can uncover hidden momentum that other people just don't see. You get to use indicators that are actually accurate. And maybe most importantly, you learn how to time your exits perfectly to squeeze every last penny out of your winning trades. Here's a perfect example of what I mean. You know those classic indicators like stochastics? They have a huge flaw. They kind of work okay in choppy, sideways markets, but the second a strong trend takes off, they start spitting out false signals left and right. But volatility-based indicators are built totally differently. They're what we call trend compensated, which means they automatically adjust to what the market is doing, so they stay accurate whether the market is ripping higher or just bouncing around. And that is a massive advantage.
And that brings us to the all-important exit. You know, getting into a trade is only half the game. This quote just says it all, doesn't it? If you get out too early or get out too late, you're leaving money on the table. And that is basically the same thing as taking a loss. Using volatility gives you the clarity you need to nail your exits with precision right when the time is right. Okay, we've talked about the market, the charts, the tools, but there's one final piece to this whole puzzle, and honestly, it might just be the most important one of all. It's about what's going on right between your ears. You have to realize the financial media is just this constant fire hose of information, opinions, and, well, panic. It's not built to help you make smart trades. It's built to get ratings. And how do they get ratings? By making you feel something. Fear, greed, you name it. And as we all know, emotional decisions are almost always bad trading decisions. So what's the solution? Well, think of it like a trader's meditation. It's really a discipline. It means you train yourself to focus your attention only on your own consistent set of methods, your volatility tools. And when you do that, you're consciously tuning out all that garbage, you're neutralizing the biased junk from the news, and it lets you make your decisions from a place of real, heightened objectivity. And look, if you ever need a little reminder to ignore all that noise, just think about this quote. It says everything. Those news channels, their goals and your goals are not the same, not even close. When their ratings go up, they don't deposit any of that money into your trading account, do they? So your focus has to be on your own analysis, period. So here we are, right back where we started. You have a choice. You can keep looking at the market the way everyone else does and see only fear, danger, and risk. Or you can learn to see it like a mountaineer, armed with the right perspective and the right tools to find the path that turns all that scary volatility into your greatest friend. Really, the choice is yours.
All right, let's get right into it. Today, we're going to talk about a whole new way of looking at trading, one that goes way beyond the standard stuff you see everywhere. We're not just looking at charts, we're talking about a philosophy for building a real, personal advantage in the markets. You know, how you can stop using the same old tools as everyone else and start forging an edge that's truly your own.
But first, to get started, we're actually going to travel millions of miles away from Wall Street. We're going to talk about a massive, catastrophic failure in outer space. And believe me, it's a heck of a lesson on how the tiniest, simplest error can have absolutely disastrous results.
Just look at that number. $327 million. That was the total cost of the Mars Climate Orbiter mission. I mean, think about that. A huge investment in brain power, in technology, in years of human effort. The stakes just couldn't have been higher.
But what's truly mind-boggling is that this entire mission, all that money, all that work, it wasn't lost because of some crazy, complex mechanical failure or some unforeseen cosmic event. Nope. It was lost because of one single, unbelievably simple mistake.
So picture this. The orbiter launches from Cape Canaveral and spends more than 9 months just cruising through space toward Mars, making these tiny, super precise course corrections the whole way. And then, on September 23, 1999, it's making its final approach. And the signal just dies. Forever.
And here's the culprit. This is what caused the whole thing. A piece of software on the ground was calculating force using English units, pound seconds. But the spacecraft's own navigation software was built to expect metric units, Newton seconds. That tiny little translation error sent the orbiter way too close to Mars, and it just burned up in the atmosphere.
It's a wild story for sure. But what on earth does a lost spacecraft have to do with your trading account? The answer, it turns out, is everything. Because in trading, just like in space travel, using the wrong measurements or making a simple, unchecked assumption can lead to total, complete disaster.
And this brings us right to the heart of a huge problem for so many traders. We tend to grab these publicly available tools, these common indicators, without really understanding how they work, and more importantly, without them giving us any kind of genuine edge.
This quote absolutely nails it. See, the moment a trading tool or strategy becomes common knowledge, its power starts to disappear. The market just adapts. What used to be a secret edge becomes the baseline, and its effectiveness gets completely wiped out.
So what do you do? Well, it all boils down to what the author calls the 3B rule. To get a real advantage, you have to either build your own tools from the ground up, tailored to exactly how you trade, or you buy a proprietary proven system. The one thing you should not do is just borrow what everyone else is using for free from the public domain.
Okay, so if borrowing tools is the problem, then what's the answer? Well, it lies in a totally different way of thinking. It's about creating a framework for yourself, one based on volatility that helps you make really high probability decisions.
And this hierarchy here is absolutely key. Your framework is your big picture philosophy. It's your North Star. That framework then guides the system you use, which in turn is made up of your specific methods and indicators. The way you make decisions is so much more important than any single little tool.
Now, a critical part of that framework is a concept called cross-verification. And the best way to think about it is to think about your phone's GPS. It doesn't just rely on one satellite, right? It needs to get a signal from at least 4 different independent satellites to figure out exactly where you are. Trading is the same thing. You don't want 4 different momentum indicators all telling you the same thing. You want independent types of analysis that all happen to be pointing to the exact same conclusion.
Okay, so enough with the theory. Let's actually see what this looks like in practice. We're going to break down how this whole framework comes to life layer by layer on an actual stock chart.
So first things first, you lay down the map. These support and resistance lines are created based on past volatility, and they basically create a landscape for the price. They show you where the potential roadblocks and turning points might be, giving you context for whatever happens next.
All right, once our map is in place, now we look for the signal. In this case, it's something called an Adeo signal. This thing pops up when price moves so far so fast that it becomes statistically out of bounds. You can almost think of it like a rubber band being stretched to its absolute limit. It's a calculated heads-up that a reversal is probably coming.
And here it is. This is the moment where it all comes together. We get that Adeo long signal. That's our signal. And look where it happens, right at a key support and resistance line from our map. And on top of that, it's confirmed by other different types of indicators. The signal, the map, and the confirmation all line up perfectly. It's just like that GPS getting a solid lock from multiple satellites. That is the power of cross-verification, and that is a robust, high-probability decision.
So, the big takeaway here is that true mastery in a competitive field like trading, it just doesn't come from copying somebody else. It comes from doing the deep, personal work, from really understanding your process. It comes from discovering by doing.
You know, this quote from the legendary coach Vince Lombardi just captures that spirit perfectly. Success demands total commitment. The market really is a battlefield, and if you want to win, you have to be willing to put in the work to forge your own path to victory.
So I'll leave you with this question to think about. When you look at your own trading, are you just using a borrowed weapon, one that everybody else has access to? Or are you taking the time to forge a weapon that is uniquely and powerfully your own?
I want to kick things off with a bit of a riddle. What does high-stakes finance have in common with the natural world? You know the answer is a whole lot more than you think. Today, we're going to uncover a sort of hidden language that connects them both, a language that just might help predict the future. And it all starts with this little guy, the sandpiper. Seriously, what could this tiny bird hopping around on the beach possibly have in common with a Wall Street trader who's managing millions of dollars? Well, the answer is all about how they both deal with risk. I mean, just think about the sandpiper's life for a second. It's this constant, high-stakes game. It has to figure out the exact moment to run toward the water, just how far to go to snag some food, and then when to get the heck out before a wave comes crashing down. Sound familiar? It should. Those are the exact same life-or-this questions a trader faces every single day. So how does it do it? How does it survive? Well, the secret is this little bird is basically a walking, talking volatility computer. It's not just looking at the next wave. No, it's feeling the energy of all the waves, that constant push and pull. It's literally using the past to predict the immediate future. It's measuring volatility. And that brings us from a sandy beach right to Wall Street. The sandpiper's gut instinct? Well, it has a much fancier name in finance: historical volatility. All it is a way to measure how much a price has bounced around over a certain amount of time. And the most common way to figure that out is with a tool called standard deviation. Okay, I know what you're thinking, math. But hey, don't worry, this isn't some crazy advanced calculus. The idea is actually super simple. And besides, your computer does all the heavy lifting. It just boils down to these 5 steps. You find an average price, see how far each day's price strays from that average, do a little squaring and adding, and boom, you've got a number that tells you how spread out all the prices are. So why bother? What does that number actually get us? Well, it helps us predict probabilities. It takes all that chaotic price action and neatly organizes it into this classic bell curve. This lets us say things like, okay, about 68% of the time, the price should stay within this range.
It gives us a framework for what's normal and, more importantly, what's extreme.
But let's go back to those 5 steps for just a second. There's one step in there that is the key to this whole thing. Step 2, square that difference. That right there is the secret sauce. So here's why that's so crucial. By squaring the differences, the math gives much, much more importance to the really big price moves, the outliers. It makes the extremes stand out. And just like our friend the sandpiper knows the best food is right at the very edge of the water, a good trader knows the biggest opportunities are found at the market's extremes.
Now, theory is great and all, but let's see how this actually plays out in the real world. We're going to dive into a classic case study with Microsoft stock from back in 2007, and we'll see what these volatility signals were really telling us. All right, let's break this chart down. In the top half, that's Microsoft's price. See that massive vertical gap up on October 26th? Just a huge jump. Now look at the graph on the bottom. That's our standard deviation. See how that line just explodes upward right after the price jump? That's a picture of volatility going through the roof. The market just got a whole lot less predictable. And this is what's so cool about it. Volatility isn't just a bunch of numbers. It's a direct measurement of human emotion. That spike shows us that traders suddenly got really uncertain, kind of jittery. That big change made them question everything, and that led to these wider, more chaotic price swings, even after that first big move. This is really powerful stuff, for sure, but it does raise a pretty important question. In a world full of supercomputers and crazy complex algorithms, is this one simple calculation really enough to give you a true edge in the markets? And the answer is, well, it's yes and no. Yes, because standard deviation is an amazing tool for measuring the human behavior that really drives the market. But it's also no, because it doesn't always show the full influence of the big institutional players. To see the whole picture, we've got to look at the tools they use. And that brings us to the really fun part of our story. We're going beyond the basics now to look at the market the way the big institutions do. We're about to decode Wall Street's hidden language and find the invisible price levels they were all watching. So let's hop in our time machine. We're going back to October 25th. This is the day before that massive price jump in Microsoft. Using more advanced volatility tools, the pro traders were already mapping out the key price levels. They weren't reacting, you see. They were getting prepared. First, the pros look at an intermediate time frame, in this case, a 3-day chart. Looking at a few days at once helps filter out all the random daily noise. And on this view, their calculation identified a critical resistance level. You can think of it like a price ceiling, at $35.10. Okay, that's the first pin on their map. Next up, these zoom out to a weekly view. It's a different time frame, a different calculation, but what do you know? It finds another key resistance level at $35.53. I mean, that is incredibly close to the other one. This gives them huge confirmation that this whole price zone is a big, big deal. And finally, they look at the really big picture, the monthly chart. This long-term view identified the upper limit, another major resistance level way up there at $37.21. So now they have a complete map, a short-term ceiling and a long-term target zone. So get this, before the market even opened on October 26th, the pros had this map. They had identified these invisible lines that most retail traders had no clue even existed. They knew exactly where the battle lines were going to be drawn. So let's see what happened when the bell rang. And here is the payoff. It's just incredible. The price gapped up, blew past that first resistance zone, and then stopped almost exactly at that long-term level of $37.21 that we saw on the monthly chart. Then, when it pulled back, it found support right on the lines they'd identified the day before. The market followed their map perfectly. What this all comes down to is a really fundamental truth about the markets. You see, most people out there are playing checkers, just reacting to the last move. But the professionals, they're using volatility to see the whole board. They're playing chess, and they're thinking moves and moves ahead. By understanding volatility, you stop just reacting to the waves, and you start measuring their energy. Just like that little sandpiper. You start seeing the hidden structure underneath all the noise. So the only question left is, are you ready to see the whole board? Have you ever just stared at a stock chart and it feels like you're looking at pure random chaos? Just a jumble of ups and downs with absolutely no rhyme or reason?
Well, today, we're going to decode that chaos. We are about to uncover a hidden language that the market uses to telegraph its next move. I mean, just look at this. It's a pretty standard daily chart, right? You see the price jump up, it falls down, it goes sideways. But why? Why does it decide to turn around at these very specific points? It seems totally unpredictable. And honestly, this is the exact problem that trips up so many traders. But what if I told you there's an order to all this madness? A hidden structure, lurking just beneath the surface, that's practically whispering where the real turning points are going to be. What if you could actually learn to see it? That's the big question we're diving into right now. So, our first clue to solving this whole mystery lies in a concept you've probably heard of, but maybe not quite like this. It's volatility. And it turns out, volatility has two very, very different faces. One is always looking at the past, and the other, well, that one's looking straight into the future. Now, you gotta stick with me here, because to really get these two types of volatility, all we need is a simple and, okay, maybe a slightly strange analogy. Just think about your toes. Yeah, you heard me, your toes. It's really that simple. All right, first up, we've got historical volatility. Think of it like this. You look down, you count your toes. You've got 10. You had 10 yesterday and the day before that. Since nothing's changed, your historical toe volatility is super low. It's just a measure of what's already happened. It's a fact. And then we have implied volatility. This is all about tomorrow. You look around, you're in a safe place, so you fully expect to have 10 toes tomorrow, right? Your expected, or your implied, future volatility is also low. It's a projection. It's a forward-looking guess based on current conditions. So let's just make sure we're totally clear on the difference here. On the one hand, you have historical volatility. It's calculated from price movements that have already happened. It's old news. It's history. But on the other hand, you've got implied volatility. And this is derived from what people are paying for options contracts right now. It's a live, breathing measure of what the market expects to happen next. And you know what? This is where things get really, really powerful. That difference, looking at the past versus looking at the future, that is not just some small detail. It's everything. Because one of these has a secret ingredient that gives it an unbelievable edge. So here's how it all works. A theoretical price for an option, well, it uses historical data as one of its inputs. But for implied volatility, we do something kind of radical. We just toss that history out the window. Instead, we plug in the actual price people are paying for those options in the real world at this very second. And that right there is the key. Implied volatility is not some analyst's opinion on TV. It's not a sentiment poll. It's literally derived from the collective bets of thousands of traders who are putting their own real, hard-fought-for money on the line based on where they believe that price is headed. Now that has conviction. Okay, so we've got this really powerful, forward-looking tool. But how does this help us solve the mystery of that chaotic chart we started with? Well, let's connect the dots and make the invisible visible. This is the big reveal. So here we are again, back to our seemingly random chart. Price is just kind of flying all over the place with no clear guideposts. No obvious reason for why it turns where it turns. Now, I want you to hold this image in your mind. Okay, you ready? Now watch what happens. Look at that. It's like someone just turned the lights on. By overlaying these bands that are derived from projected implied volatility, a hidden structure just appears. The price, which seemed totally random, is now suddenly respecting these lines, bouncing off them like they're invisible walls. What we're seeing here is just incredible. Those unpredictable reversals and pauses, they were never random at all. They are happening at key levels of support and resistance that are defined by the collective bets of all those options traders. We've just decoded the market's hidden language. Now, this is way more than just a neat visual trick. This is about getting a real, tangible edge in the market. So let's talk about why this really matters and how it can fundamentally change the way you see everything. I want you to think about it like this. As an individual trader, you're often playing against huge institutions, the smart money. It's like you're sitting down at a blackjack table where all the other players and the dealer can communicate telepathically, but you can't hear a thing. You are at a massive disadvantage. But tools based on this idea, on projected implied volatility, or PIV, they can level that playing field. They identify the primary support and resistance levels, the ones the big players are actually watching. This helps you confirm when a new trend is starting and can vastly improve your entry and exit points for your trades. You're no longer just guessing, you're actually seeing the map that they're using. So remember, this is not some brand new, untested theory. The biggest financial institutions in the world have entire teams of quants using this exact logic to trade every single day. They've been listening to the market's hidden language for years. Now that you know it exists, the only question left is, are you going to start listening too?
Welcome to The Explainer. So, today we're going to talk about a trading framework. But here's the twist. It's not about crystal balls or predicting the future. Nope. It's all about understanding what's happening right now. And honestly, this shift in mindset, it could totally change how you look at the market.
Okay, so to really get this, we've got to start with a story. It's a great one, and it just perfectly captures the challenge every single trader runs into. Picture this. We're down on the bayou with two old buddies, Boudreaux and Mathern. They get into a deal over a horse, but what it really shows us is, well, everything about the psychology of value. So the whole thing kicks off when Boudreaux buys this amazing white stallion for his wife. Great anniversary gift, right? Well, his friend Mathern pops over, sees the horse, and he is just blown away. Instantly wants it. And this moment, right here, this is where the real trading story gets started.
And what happens next is just this wild series of trades. So get this. Boudreaux's wife gets tired of the horse, so he sells it to Mathern, makes a quick $500. Easy money, right? But then she changes her mind. So Boudreaux has to buy it back, this time for $2,000. And this pattern, this back and forth, it goes on for over a year. The price just keeps ticking up by $500 each time until finally Mathern sells the horse to some traveling salesman from out of town.
So when Boudreaux finds out the horse has been sold to an outsider, he completely loses it. He storms over to Mathern's place, furious, and yells this at him. And that line, man, it reveals everything. It shows this huge flaw in how he's thinking. See, for Boudreaux, the horse wasn't really an asset with a market value. It was just this game he played with his friend to make some cash.
Okay, so obviously this story isn't really about a horse, right? It's a parable. It's about two totally different mindsets, and if you're a trader, you absolutely have to understand both. It really boils down to this. Are you a Boudreaux or are you a Mathern?
Let's break it down. On one hand, you've got Boudreaux. He's completely trapped by his emotions, right? His decisions are all over the place. He can only see value inside his little bubble with his friend. But then you have Mathern. He's the total opposite. He's objective. He keeps his business and his feelings separate. He sees the big picture, what that horse is actually worth to the rest of the world. And because of that, he's the one making smart, rational choices.
All right, so how do we take this story and actually use it? How can we build a system to get over our own emotional trading habits? Because let's be real, we all have a little Boudreaux inside of us, right? The goal here is to learn how to quiet that voice, the one that clouds our judgment with all those feelings and biases.
And that brings us to the million-dollar question for any trader. How do you do it? How do you actually systematically kick that emotional, inconsistent Boudreaux out of your head when it's time to make a decision? How do we build a real structure, a framework that lets us think like Mathern?
Well, the answer is kind of a paradox, but it's a really powerful one. It's this. When you're doing your analysis, you need to think like a child, just full of curiosity, no limits. But when it's time to pull the trigger on a trade, that's when you have to be matter-of-facta. All business, totally objective, totally disciplined.
And why think like a child? Well, it's pretty fascinating when you think about it. Kids are amazing learners, right? They're always trying to figure out the real reason for things. They just keep asking, why? And here's the key part. They take in new information without any of the baggage or biases we adults have. They don't have these preconceived ideas about how the market is supposed to work. And that open-mindedness, that's exactly how you spot new patterns that everyone else is missing.
Okay, so to really put this Mathern mindset into practice, you need a tool. You need a new way of looking at things, a lens that helps you see the market not just as price going up and down, but in terms of something way more fundamental, volatility.
We've all seen this, right? This is where we all start. A standard price chart. It's just a sea of candlesticks, up, down, all over the place. And if you don't know what you're looking at, it just looks like random noise. But for a technical analyst, this is a blank canvas. It's just waiting for some context.
So now imagine we take that canvas and we weave a set of threads right into it. That's the idea behind something called the volatility fabric. It's like adding a backdrop that suddenly gives context to every single one of those price moves. It shows you what each move really means compared to how that stock or asset normally behaves.
And boom, here's the aftershot. With that fabric laid over the chart, those same price wiggles aren't just floating in space anymore. Now they're part of a framework. And that framework immediately tells you how big of a deal each move actually is or isn't.
Now, this is super important, so let's be clear. This fabric is not some magic indicator. It's not going to flash buy or sell at you. Think of it as a training tool. Its whole job is to literally retrain your brain, to get you to stop seeing price just in terms of dollars and cents and start seeing it in units of volatility.
So when it comes to weaving this fabric, there are basically two main ways to do it. Let's dig into both and see which one really gives us a clearer picture of what the market's up to.
Okay, check this out. On the left, we've got a fabric built on standard deviation. If you've ever used Bollinger Bands, this will look pretty familiar. Then on the right, you've got one based on linear regression and average true range, or ATR. See the difference? Look at how the bands on the right just kind of hug the price action. They're tight. Meanwhile, the ones on the left are much wider, more prone to these big sweeping swings.
The source material is pretty clear on this. The linear regression version is the way to go. And the reason is simple. It's building blocks, like the average true range, which, by the way, is just a fancy way of saying the average size of a price move. They do a much better job of showing what traders are actually doing. It makes it almost impossible to miss when volatility is expanding or contracting. It just gives you a way clearer map of what's normal and what's totally nuts.
Okay, so what's the big payoff? Why go through all this trouble of training your brain to see this fabric? Well, it's because you learn how to spot a specific, incredibly powerful pattern. A pattern that often shows up right before a massive market move. You know, markets are a lot like life, really. They go through cycles. You have these quiet, calm periods where not much is happening. That's contraction. And then almost always that's followed by a period of chaos and big moves. That's expansion. The real trick, the real opportunity, is being able to spot that exact moment when things are about to shift from calm to chaos. And this image right here shows you the setup perfectly. We've got both fabrics laid on top of each other. See that circled area? The darker standard deviation fabric is being literally squeezed inside the lighter linear regression one. That is the telltale sign. It's like a spring being coiled tighter and tighter. All that energy is building up, and it's getting ready to explode. And the source material does not mess around when describing this. They call this pattern a nuclear-grade signal. I mean, wow. That tells you a huge, often explosive price move is very, very likely about to happen. This is the pattern you've been training your eyes to find.
So that leaves us with one last question to think about. After everything we've talked about, are you still just watching the price, like Boudreaux watching that horse go back and forth? Or are you starting to train yourself to be like Mathern, to see that invisible force, that underlying volatility that's really driving the market? The choice and the opportunity that comes with it is all yours.
If you're a trader, you know the feeling. A strategy that's been your go-to for years just stops working. Your discipline is the same, your rules haven't changed, so what gives? Well, in this explainer, we're going to break down why your classic charting tools might not just be failing you, they might be actively lying to you in today's markets. It really is the million-dollar question, isn't it? You follow a proven, back-tested method, and then, out of nowhere, it feels like the game has completely changed. So, what's really going on here? Turns out, the answer might not be about your strategy at all, but about the market itself. And there you have it. This is the core idea from our source material. It's not you, it's the market. The very nature of how prices move has fundamentally shifted, and that shift has made a lot of trusted, old-school tools pretty much obsolete. Okay, so let's dig into that. This isn't just some vague feeling that something is off. The source material actually points to a measurable, observable shift in how the market behaves, a shift that started at a very specific time. Yep, right around the early 2000s, things started to get weird. There was this noticeable uptick in the failure rate of classic chart patterns, things like Fibonacci retracements, you name it. The old playbooks just weren't keeping up because the very DNA of the market was evolving. Here's a great way to think about it. Think about music. Decades ago, we had vinyl records, a physical, visual thing. Today, it's all digital files, right? It's data. Well, trading has gone through the exact same shift. We used to rely on visual analysis, what we could see on a chart, but today's markets are driven by forces that are mathematical, algorithmic. We need new tools to read this new language. All right, let's start busting some myths. First up, the simple, the elegant, and the often very, very wrong trend line. And you got to admit, it looks great, doesn't it? You connect a couple of low points, you draw a nice straight line out into the future, and bam, you've got a perfect roadmap for buying the dips. It looks so clean, so logical, so easy. And, for a little while, it might even work. But here is the massive fundamental problem. A real trend doesn't move in a straight, predictable line. As a trend gains momentum, it accelerates, it gets steeper, and it pulls away from that simple line you drew. So if you're waiting for the price to pull back to your static trend line, you're often just left behind, missing the best part of the entire move. So here's the bottom line. Trend lines are two-dimensional tools trying to operate in a three-dimensional market. Their fatal flaw is that they just can't adapt to the changing speed, the volatility of a trend. They are static in an environment that is anything but. Okay, so if a static line doesn't work, what about a dynamic one? Well, that brings us to our second myth, this idea that there's some kind of magic moving average out there that can perfectly define support and resistance. Let's take a look at this chart. We've got 3 popular moving averages slapped on here. We're told these lines are supposed to act as dynamic support or resistance, but what's actually happening? The price is just slicing right through them like they're not even there. It's absolute chaos. I mean, which one are you even supposed to be looking at? And this really gets to the heart of the problem. There is absolutely zero consensus on which moving average is the one. Ask 10 different traders and you'll get 10 different answers. The 50, the 200, the 21. The list is literally endless. And if nobody can even agree on which one matters, how can any single one of them possibly have any real predictive power? Now, check out this comparison. On the left, you've got that messy moving average chart. On the right, it's the exact same price action, but we're viewing it through a lens of volatility. And all of a sudden, clarity. Look at circles 1, 2, and 3. Price hits these volatility bands and reverses, giving you actual definable levels, where the moving averages just showed you, well, nothing but confusion. And that leads us to our final and maybe the most tempting myth of all, the idea that the markets are all governed by some kind of secret code, the golden ratio of Fibonacci retracements. At first glance, Fibonacci can feel like pure magic. So here, on this chart, we draw a grid from the high to the low. And just look at that first trade in circle 1. Price rallies perfectly to the 61.8% level and then reverses. A beautiful, profitable trade. It feels like you've unlocked a secret of the universe. But don't get too comfortable. Because after that one perfect trade, what happens? Utter chaos. The price just blows right through the other lines like they don't even exist. So instead of giving you clarity, the Fibonacci grid just creates confusion. Every single line becomes a potential entry or exit, which leads to hesitation and, let's be honest, probably a string of losing trades. The author calls this a shell game, and that is the perfect description. The real danger of Fibonacci is that it makes you focus on a bunch of arbitrary lines instead of building a solid framework based on what the market is actually doing right now. So, if trend lines are out, moving averages are a mess, and Fibonacci is a shell game, what's the answer? Well, it's all about adding a missing dimension to our analysis. The source makes a great point here. Relying on traditional chart patterns is a lot like lying on the grass and seeing shapes in the clouds. You see a rabbit, your friend sees an elephant. Who's right? Well, in trading, that kind of subjectivity is deadly. One person's head and shoulders top is another person's noisy consolidation. This slide really just lays out the whole paradigm shift perfectly. Traditional analysis is two-dimensional. It's just price and time. It's subjective, it's static, and it's always lagging. Volatility-based analysis adds that crucial third dimension. It's mathematically derived, it's objective, and it adapts in real time. It's a framework built for the markets we have today, not the markets of 1995. And this is the key takeaway. The point isn't to just throw out the concepts of support and resistance. Those ideas are timeless. They will always be valid. But the way we find those levels has to evolve. It's time to put down the vinyl record and pick up the digital player. So we'll leave you with this question to think about. Take a really hard look at the tools that you rely on every day. Are they simple, static lines from a bygone era? Or are they built to measure the one thing that truly defines modern markets, volatility? The answer to that question could change everything for you. Thanks for joining us for this explainer.
You ever watch the market and feel like you're trying to guess the mood of a huge, unpredictable crowd? One day, everyone's euphoric. The next day, they're panicking. It feels totally random, but
What if it's not? What if it's all just human nature playing out on a massive scale? Well, today, we're diving into exactly that, how understanding the market's herd mentality is the real key to timing its next big move.
I mean, think about it for a second. You're watching some sitcom, the joke is fine, but it's not that funny. And yet you find yourself laughing. Why? Because you hear that laugh track. It's a social cue. We are just wired to go along with the people around us, even if they're just pre-recorded sounds on a TV show.
Okay, now let's take that same instinct and crank up the stakes. Imagine you're in a crowded theater and one person suddenly yells fire. What's the first impulse? It's not to calmly look for smoke, is it? No way. You see one person panic, you feel that panic, and you run. We follow the herd, especially when things are uncertain. It's just a deep, powerful survival instinct.
And this, right here, is the heart of it all. The stock market isn't just a bunch of numbers and charts on a screen. It's a collection of millions of people, all with the same human wiring, the same social pressures, the same fears, and the same greed. So, because we act like a herd, the market acts like a herd too.
All of that collective buying and selling, that fear and greed, it creates what we call the market swing. And here's the most important takeaway. Being able to see this swing coming is the single most important skill you can have in trading. Seriously, it's way more important than picking the perfect stock. Because when the whole herd stampedes, it doesn't matter how great your one little stock is.
So, if it's that important, how do we actually start to predict these swings? Well, it starts by zooming out. Before we get lost in all the daily noise and chaos, we have to learn how to see the big picture, that intermediate-term trend. Let's just break down these time frames so we're all on the same page. The short term, that's the daily noise, the choppy waves. The long term, that's the major tide for big long-term investing. But for us, for timing the market, the sweet spot is right in the middle. The intermediate term is the underlying current. And if you don't know which way that current is flowing, you're going to have a really hard time getting anywhere.
Now, it's really tempting to look for that one magic indicator, that one secret tool that's going to tell you everything. But trying to predict something as complex as the market with a single tool, that's kind of like trying to forecast a hurricane using only a thermometer. Sure, it gives you a piece of the puzzle, but you are missing almost everything else.
And this chart of the S&P 500 just illustrates that point perfectly. See that indicator at the bottom? That's a classic overbought/oversold tool. And you'll notice it actually does a pretty good job of spotting the market bottoms. See how the green circles line up pretty well with the lows? But now look at the tops, marked with those red X's. The indicator, it completely misses them. It's a useful tool for sure, but it's not a complete system, not even close.
So if one indicator isn't enough, what else do we need? We need a warning. Something that cuts through all the noise, like a demolition expert yelling that final warning right before the big explosion. Well, for traders, that warning has a name: market breadth.
The beauty of market breadth is that it's simple and it's honest. It doesn't have an opinion. It's just the raw number of stocks going up versus the number of stocks going down. Think about it. The big indexes might still be climbing, but if under the surface more and more individual stocks are starting to fall, that's a huge warning sign. That's where you see the big money starting to quietly head for the exits. On this chart, those correction signals, the skulls, they show up right before a downturn, and the surge signals, the bulls, they tend to pop up right near a bottom. This is the market's collective voice telling you what it's about to do.
All right, so market breadth gives us that powerful read on the intermediate current. Now that we have that big picture in mind, let's zoom in and see how we can read the short-term waves. And this requires a pretty major shift in how you think.
The author uses this fantastic analogy about flying out of Hawaii. When you're at 500 feet, all you can see are the small, choppy waves caused by the wind. But as the plane climbs to 5,000 feet, a completely new, much larger pattern emerges: the huge, powerful ocean current. The market is exactly the same. The short-term swings and the intermediate-term swings are just different wave patterns, and you can only see them from the right altitude. And this slide right here captures that mental shift you have to make. For the intermediate term, the big picture, we analyze the whole stock market as if it's one single thing to figure out its main direction. But for the short term, we have to zoom in. We have to start seeing it as a market of stocks and look for individual opportunities that are flowing with that broader current. So, with that framework in mind, how do we know the exact moment? When is that short-term swing really about to happen? How do you know when the rubber band has been stretched to its limit? You know, the answer isn't some secret final signal on a chart.
It's actually about quantity and quality. The best traders know a swing is coming when they scan the market and suddenly find an overwhelming number of their favorite A-plus trade setups, all appearing at the exact same time. The opportunities are so good and so numerous, they are practically jumping off the screen, begging you to trade them. That is the real tell.
Okay, enough theory. Let's make this really concrete. Let's look at how a complete, volatility-based framework makes a real-world, dollars and cents difference in a single trade.
So what we've got here are two looks at the exact same trade in a company called BioReference Labs. On the left, a pretty basic analysis. On the right, the same trade, same time period, but this time analyzed with a complete framework using more advanced volatility-based tools. The only difference is the intelligence applied to the chart.
Okay, let's just break down the numbers. The basic analysis gives you an 11% profit. Hey, not bad, right? But the complete framework, because it uses these precise volatility-based support and resistance levels, it allows for a much better entry point and a more optimal exit. And that pushes the profit all the way up to 14.7%. Now, a few percentage points might not seem like a huge deal, but let's look at what that actually means for your wallet.
The difference between that 11% profit and the 14.7% profit, it's a 33% increase in the actual money you take home from the trade. Let me say that again, a 33% profit differential. That is the power of using a superior framework. And over dozens or hundreds of trades, that kind of edge is the difference between being profitable and, well, not.
And all of this brings us to our final and, I think, most crucial point. Trading isn't just about reading charts, it's a strategic battle. And in any battle, preparation is everything. You have to find your advantage before the fight even starts.
Let's just call it what it is. Trading is mental combat. You are competing against some of the smartest, fastest, most well-funded people and institutions in the world. And if you want to win, or even just survive, you have to be better prepared.
On the eve of the Battle of Gettysburg, a Union cavalry general named John Buford got there first. Now, he was outnumbered, and his orders were just to scout, not to fight, but he immediately saw the incredible strategic value of the high ground, the ridges that overlooked the town. He made the call to dig in and defend that ground. And that single decision, made in advance, gave his army a critical advantage that arguably decided the most important battle of the entire war.
That story is such a powerful metaphor for trading. Remember that herd mentality we talked about at the beginning? Your framework, your system, your ability to read the market swings, that is your high ground. It's the vantage point that lets you see the herd gathering before it starts to stampede. It allows you to act with foresight, not just react with panic. And you have to do the hard work to secure that high ground before you ever put a single dollar at risk. You make the sacrifice in preparation, so you don't have to make it in the market.
So I'm just going to leave you with this one question. When you look at the market, when you're getting ready to make your next trade, have you really done the work? Have you secured every possible advantage you can? In short, have you found your high ground?
What if the key to spotting huge stock market reversals was hidden inside a cartoon from the 1930s? Well, today we're going to dig into a really powerful trading concept called the Adeo, and our guide is not who you'd expect.
Yeah, that's right, Popeye the Sailor Man. It might sound crazy, but he actually holds a fantastic key to understanding how markets turn on a dime. I mean, think about it. In every single cartoon, Bluto pushes him around and pushes him until it looks like there's no way out. Just think of Bluto as the market, shoving a stock's price down, down, down.
And then, right when he hits his absolute limit, he says his famous line. That's his breaking point. He cracks open that can of spinach and bam! The whole situation dramatically reverses. And you know what? Stocks do the exact same thing. They get pushed to a breaking point.
And in the world of trading, that breaking point has a very specific name. We call it the Adeo.
So what in the world is an Adeo? And more importantly, how do we spot one coming?
The Adeo point, it actually comes from the Latin phrase for to such an extent. It basically means things have gone too far. It's that moment on a chart when a stock's price has been shoved to an extreme boundary, somewhere it really shouldn't be. And that tells us one of two things is about to happen. Either it's about to snap back like a rubber band, just like Popeye, or it's a nasty trap for traders who aren't paying attention.
But here's the million-dollar question. Is every single one of these breaking points a golden opportunity? Well, not exactly. You see, there are really three different flavors of Adeo. First, you've got a fundamental change. This is when there's actual company news driving the price. That's really hard to trade off a chart.
The second one, though, this is the one we're looking for, the technical reversal. This is our can of spinach. There's no news, but the price slams into some kind of invisible mathematical support level that the pros know about. And then there's the third kind, the unexplainable. No news, no technical reason, it's just a big question mark. That's the one you want to stay away from.
Okay, so if that technical reversal is the one we want, how do we find it? Let's take a look at an early attempt to build a tool that could hunt for these exact moments.
Whoa, okay. Don't let all this code on the screen freak you out. We are not about to do a deep dive into programming. What's really important here is the idea behind the code. This was a simple tool called the TTI composite, and it was designed specifically to hunt for Adeo points.
Now, the logic behind it was actually pretty smart. Instead of just looking at where the price is, this tool tried to measure the speed and direction of the price move. It was trying to see how fast the stock was accelerating towards that breaking point.
It really follows that old saying, you know? It's not where you are at, but where you are heading. That's important. It's all about trying to anticipate the move by gauging its intensity.
But here's the problem. When you actually use the tool on a real chart, the results are, well, they're kind of weak. You can see the signals here, these thin little vertical lines. Yeah, they kind of point to some turning points, but they just don't feel convincing, right? There's no real reason to jump in and risk your money. Something's missing.
And here's the problem in a nutshell. This tool is like trying to guess when Popeye is going to snap, but you have no idea where the can of spinach is hidden. It can tell you he's getting angry, sure, but without knowing that exact spot where he finds his strength, the signal is pretty much useless.
So let's add that missing piece of the puzzle and see if we can uncover the real Adeo points. Okay, now this is cool. Look at the difference here. On the left, you've got that same chart we just saw with its kind of lame signals. But on the right, using a much better tool, boom, all of a sudden these invisible lines of support and resistance just appear on the chart. And the real Adeo points, you can see them circled, suddenly become obvious.
And that right there, that's the missing ingredient. It's something called volatility-based support and resistance. These are levels that are calculated mathematically based on how much a stock normally swings up and down. They're like invisible guardrails for the price. This, my friends, is the financial can of spinach. It tells us exactly where the market is most likely to hit its breaking point.
And this table just lays it all out perfectly. To really nail an idea, you have to measure a bunch of different things. Our first attempt, the TTI composite, was only using 3 of the 7 key ingredients. And most importantly, look at number 4. It was completely blind to support and resistance. The more advanced tool uses 6 out of 7, which gives it a way more complete picture of what's really going on.
Okay, this is all great, but theory doesn't make money. So now that we know how to find a real Adeo, how do you actually trade it?
Let's walk through a real-world example. This is a stock called Bucyrus, ticker BUCY, way back on May 22, 2008. The stock was in a nice, strong uptrend, and then it pulled back right to one of those key volatility-based support lines. That is a textbook setup for a potential Adeo reversal.
But finding the setup, that's just step 1. The next question you have to ask is the most important one. Is the potential reward here actually worth the risk I'm about to take? To answer that question, you have to get specific. You need to make 3 critical decisions before you ever click the buy button. You need to know your exact entry point, where you're going to get out if you're wrong, that's your stop loss, and where you plan to take profits if you're right.
And this is exactly what that homework looks like for our BUCY trade. We look to buy right at that support level, $64.24. Our risk, our stop loss, is just below the next support level down, so we're risking about $2.94 per share. Now, our potential reward, based on where the stock has been recently, we're looking at anywhere from $6.76 to $9.76 a share. That gives us a reward to risk ratio of at least 2.3 to 1, maybe even 3.3 to 1.
So think about that. In the best case scenario, you're risking $1 for the chance to make $3.30. That is a professional, high-probability trade. That's what happens when you know where to find the spinach.
So I'll leave you with this to think about. Any stock chart can look like a total mess, just a sea of chaotic noise. But if you're only looking at the price wiggling up and down, without seeing that hidden structure underneath, how much of the real story, how much of the why are you actually missing? How much are you missing by not knowing where to look for the spinach?
All right, today we're diving into a really cool trading method. It's all about finding opportunities where, honestly, most traders just see a bunch of noise.
You know those strong trends that seem impossible to jump into because there are no clear entry points? Well, this is for that. And it all kicks off with a pretty unexpected question.
Now, you gotta love this question from the source material. Have you ever played pinball? It sounds a little out of left field, right? But honestly, it's the perfect way to set the stage. The way a pinball machine works, it's a fantastic analogy for how prices really move in the market. So yeah, let's get into that. Okay, so picture this. You turn a pinball machine on its side. The stock? That's the steel ball, just flying around with its own momentum. And the bumpers, the flippers, all that stuff? That's us. That's the traders. Our buy and sell orders are what create these little temporary support and resistance levels that just, bounce the price all over the place. It's basically a game of market pinball, and it's happening on our charts every single day.
Now, all of this pinball action, it often creates a super common chart pattern. But here's the thing. It's a pattern that, conventional wisdom tells us is just way too dangerous to even think about trading.
And here it is, the classic rectangle pattern. I mean, you've probably seen this a million times. The price gets totally trapped, just bouncing back and forth between a floor of support and a ceiling of resistance. It's that clean, textbook version we all wish we could find, but let's be real, the market is almost never this neat and tidy.
So, what does the traditional playbook say about this? Well, it pretty much screams, stay away from the inside of that rectangle. It's seen as a total trap, full of false breakouts and just messy, erratic price noise. The standard advice is to just sit on your hands, wait for a breakout, and then maybe trade a pullback. But man, that approach leaves so much potential profit just sitting on the table.
And this is where the difference in perspective is just huge. The traditional view looks at this and sees nothing but danger. But the 1-2-3 view, it sees a high probability opportunity. And it's not guessing. It's using these kind of hidden support levels that are based on market volatility. And that's how it finds a clear entry point right smack in the middle of that supposedly untradeable zone.
So how do we actually do that? Well, this brings us right to the heart of it all, this really elegant solution called the 1-2-3 method.
Okay, so what exactly is the 1-2-3 method? In a nutshell, it's a structured approach that uses something called Projected Implied Volatility, or PIV for short. The easiest way to think about PIV is it's like a way to forecast future support and resistance levels. It's based on how much the market thinks a stock is going to move. This is a tool that a lot of the big institutional traders use, and it basically helps them see levels that are completely invisible on a normal price chart.
And this really gets to the big so what question, right? I mean, have you ever had that feeling, that pain, of just watching a market rocket higher day after day, and it never gives you a single dip to buy in? It's frustrating. Well, the 1-2-3 method is designed for exactly that situation. It helps you find entry points where it looks like there aren't any, turning those messy, untradeable rectangles into really clear opportunities. All right, so that's the theory. But how does this actually look on a chart? Let's break down the mechanics, step by step.
It's actually refreshingly simple. Okay, step 1, in an uptrend, the price pushes up and breaks through two of these key volatility resistance lines. Step 2, the price pulls back a bit and then closes between those two lines. That's our signal. See, the old resistance is now becoming potential support. And then step 3, that's our entry. We jump into the trade when the price comes down and touches that lower line, which is now acting as our new support level.
And this diagram from the source material, it just visualizes the whole flow perfectly. You can see that first push-up right through both lines. That's our step 1. Then, the price pulls back and closes right there between them. Boom! There's our signal from step 2. And finally, you see the entry in step 3 as the price comes back down to kiss that lower line, which is now flipped to support. It's just a really clean, repeatable setup.
Okay, theory is great and all, but let's see how this thing actually performs in the wild. We're going to walk through a real-world example with the stock AutoNation, and it doesn't just prove the concept works, it actually reveals an even deeper, more powerful insight.
All right, so here we've got a daily chart of AutoNation. You can see exactly what we talked about. The price rallied up through these two resistance lines, then it pulls back and closes right between them. That's a textbook 1-2-3 signal, so the setup is definitely there. But here's the big question. Where exactly do we enter? Do we just put an order right on that lower line? Looking at just the daily chart, you're left with a little bit of uncertainty.
And this is really the million-dollar question for any trader, isn't it? We've got this great-looking, high-probability setup, but we want to dial it in. We want to find the absolute most precise, lowest-risk entry point we can. So how do we do that?
And here's the answer. We zoom in. So on the left, you've still got our daily chart with the setup. But on the right, we've dropped down to a 60-minute chart of that same exact time period. And just look at what it reveals. The shorter time frame shows us that pinball game in real time. We can see the price action in so much more detail, and it shows us exactly where that support level is holding, which confirms our entry point with way more precision.
Let's just pause on this for a second because this is so important. Think of it like this. The daily chart gives you the what. It's the big picture, the strategy. But the hourly chart, that gives you the when. That's your tactical entry. It's when you pull the trigger.
And here's how it all played out. The trade triggers, and get this, in just one day, it hits the profit target at that upper resistance line. I mean, what a quick, clean trade. And that multi-time frame analysis? It didn't just give us the perfect entry. By looking at that hourly chart, we could also see a super clear exit point, which let us capture the absolute sweet spot of the move.
So really, the big takeaway here is that the 1-2-3 method isn't just another chart pattern to memorize. It's really a whole new way of looking at the market. It's about learning to see the hidden architecture, those volatility-based levels. And it's about finding opportunities that are just flat out invisible to most other traders.
And that kind of leaves us with one final thought to chew on. This method, it takes what almost everyone else dismisses as random, chaotic noise inside a trading range, and it turns it into a clear, actionable signal. So it really makes you wonder, right? What other pieces of conventional trading wisdom are we all following that might be causing us to completely miss powerful hidden opportunities that are staring us right in the face?
So, what if I told you that the #1 tool in your trading arsenal, your own eyes, was actually misleading you? In this explainer, we're going to hunt for a really powerful trading signal that's hiding right in plain sight. It's a type of hidden momentum that, once you learn how to spot it, well, it's going to change the way you look at charts forever. We've all been there, right? You're tearing the house apart, looking for your keys, and then you find them sitting in the most obvious spot imaginable. You probably glanced right at them a dozen times, but your brain just didn't see them. Well, it turns out that exact same blind spot happens all the time when we look at our trading charts. And the heart of the problem lies with something we all use and trust completely, our eyes. The way our charting software presents information actually creates this visual trap, making it incredibly hard to accurately see one of the most fundamental parts of any trend. It all comes down to something called slope. We all learned this back in math class, rise over run. On a chart, it's just how fast the price is moving over a certain amount of time. A steep slope means strong momentum. A gentle slope means weak momentum. Pretty straightforward, right? Well, here's the kicker. To make that chart fit perfectly on your screen, your software is constantly adjusting the dimensions. It's stretching the price axis here, squeezing the time axis there, and in the process, it completely distorts the visual angle of the trend. This is known as the aspect ratio problem, and it means that a slow, meandering trend and a powerful, explosive one can be manipulated to look almost identical. So let's see this deception in action. I'm about to show you 2 different charts, and I just want you to trust your first gut instinct. Okay, so on the screen, we've got 2 stocks in an uptrend. NVIDIA on the left and Eaton on the right. Just look at them. Visually, their slopes look pretty similar, don't they? Maybe NVIDIA's is a tiny bit steeper if you squint, but it's hardly a night and day difference. But here's the reality hiding behind that visual trick. During the period shown on the chart, NVIDIA absolutely rocketed up 147%. And Eaton, the one that looked so similar, it only gained 16%. That is a massive, almost 10-fold difference in performance that our eyes completely missed. Now, when we forget the visuals and actually calculate the true mathematical slope, NVIDIA's trend was an insanely steep 75 degrees. To put that in perspective, a 45-degree line is considered a really strong, steady trend. 75 degrees is just an absolute powerhouse move. Eaton's slope, on the other hand, was a much more modest 33 degrees. Still a decent move, but nowhere near as explosive. And there it is. That's the visual illusion in action. It totally masked the real strength of the momentum. The big takeaway here is crystal clear. We just can't eyeball a chart and expect to get the real story. We need a tool that can cut through all that visual noise and measure what's actually happening under the surface. And that brings us to the solution. See, the most overlooked form of momentum, it isn't actually found in the price movement itself. No, it's hiding in a totally different layer of the market. So where is this secret hiding spot? Where can we find a signal for future price movement that's actually reliable? The answer is implied volatility. Now, in simple terms, this is just the market's collective best guess about how much a stock is going to move in the future. So instead of looking backwards at prices, we're measuring the market's expectation of what's coming next. This is where the real energy of a trend is stored. And the tool for this job is called N-bands. The easiest way to think of them is like dynamic support and resistance levels. They get plotted right on your chart, and they're based on the current implied volatility. They basically show us the market's perceived boundaries for the price. Okay, and here is the key insight. When that lower end band starts rising, and rising steeply, it's telling us something absolutely critical. It means the market is getting less and less afraid of a price drop. The perceived risk to the downside is shrinking. Think of it like a safety net that's rising up to catch the price. That combination creates a powerful bias for a move higher. Okay, so that's a really cool theory. But does it actually work? Let's dig into the data and see how this actually plays out in the real world. An extensive study of S&P 500 stocks over 8 years found something pretty remarkable. When a buy signal happened while that lower end band had a high slope, the average potential profit over the next 10 days shot up by almost 70%. At the exact same time, the potential loss increased by less than half of that. Let me say that again, because this is the whole shebang right here. A high slope and implied volatility increases your potential profit 2.5 times more than it increases your potential loss. That's not just a fluke, that is a genuine statistical edge that points directly to hidden momentum. So, we've got the theory and we've got the data to back it up. Now, let's get practical. How do we actually spot these high probability setups on a live chart? What we're looking for is a specific pattern called a volatility shift. All right, let's look at a chart of Power Wave Technologies. The price itself looks kind of choppy, a little uncertain, but now look at the indicator pane down at the bottom. That solid line is measuring the slope of the lower end band, and you can see it spiking up to 58 degrees. That's way above the 45-degree line that tells us we're in a high slope condition. That's your alert. That's the hidden momentum building up under the surface. This exact setup is what the source material calls a volatility shift. In plain English, it's a measurable condition where the downside risk is shrinking fast, while the upside potential is holding strong or even growing. The balance of probability is tilting, and it's tilting heavily in favor of the bulls. So here it is, your simple 3-step checklist to spot this pattern. Step 1, look for a rapidly rising lower end band. You want to see a slope greater than 45 degrees. Step 2, check that the upper end band is stable or rising. This just confirms that the upside potential is still there. And step 3, when you see both of those conditions line up, you've just identified a high probability upward shift in the trading range. This whole idea really shows that our charts are layered with information, and some of the most valuable clues aren't even in the price bars themselves. It kind of makes you wonder, if something as powerful as momentum can hide in the slope of implied volatility, what other critical information are we all looking at every single day, but just failing to see?
All right, let's kick things off today with a simple story about a train. But trust me, this is not just any story. It's actually kind of puzzle, one that holds a really powerful secret about one of the toughest decisions any investor ever has to make. So I want you to picture this. You're on a train, it's clacking along the tracks, heading east. And inside there are 3 very, very different people. You've got a guy smiling, looking out the window, a woman who's nervously fidgeting, and an older gentleman who's just calmly reading his newspaper.
And right here is where it gets really interesting. See, these 3 people, they aren't just characters. They actually represent the conflicting voices inside every single trader's head when they're trying to figure out what to do with a position. So, first up, let's meet passenger number 1. This guy is confident, he's smiling, and he is 100% certain he's going to Seattle. So when somebody points out, hey, the train's heading east, away from Seattle, he just kind of laughs it off. No way. In his mind, the destination is fixed, so reality has to be wrong.
Okay, then we've got passenger number 2, and she is the total opposite. She's nervous, she can't make up her mind, she is just completely overwhelmed by all the choices. She can't pick a destination, can't make a call, and she's just constantly looking around hoping for some kind of sign to tell her what to do.
And finally, our third passenger, he's calm. Almost a little too calm. You ask him where he's going, and he just says, I don't know, but I'll know it when I see it. He's basically just waiting for the train to stop somewhere to decide if that's where he was supposed to go all along.
So what's the point of this whole train story? Well, it's this. Getting on the train, entering a trade, that's the easy part. The decision that really matters, the one that makes or breaks you, is knowing when and where to get off. It's all about designing that perfect exit.
Now, on paper, the exit is just, closing a position. But it is so much more than that. It is the single moment where a number on your screen turns into real money. And honestly, it's the most overlooked, most misunderstood, and probably the most profitable skill that you can ever master.
The problem, though, is that our inner passengers, our own biases, are always trying to mess up our exits. They push us right into these really common and really expensive psychological traps. So you got to ask yourself, which one of these passengers is driving your bus?
So let's look at the first two big traps. On one hand, you've got passenger number one's one-size-fits-all trap. This is the trader who says, I always sell for a 10% profit no matter what. It feels simple, but it totally ignores that every single stock behaves differently. And then on the flip side, you've got passenger number two's feelings-based trap. This is all about hunches, gut feelings, and that constant nagging question of, should I sell now? It's basically a recipe for total exhaustion and random results.
And look, this visual shows you exactly why that fixed rule thing is such a disaster. For a slow, steady stock, that 10% target might take forever to hit, and you're missing out on quicker, smaller wins. But for a really wild, volatile stock, that same 10% rule could have you selling way too early, leaving a ton of money on the table. One size just doesn't fit all. It really doesn't.
And this quote? This nails the problem with the feelings-based approach. I mean, think about it. Of course you wouldn't. You'd want that surgeon to look at your specific charts, your specific case, before they did anything. So why on earth would we risk our money on some vague feeling instead of a precise look at the specific stock we're in?
Okay, so this is the million-dollar question, right? We're talking about these little adjustments, just tiny improvements in timing. Does that really make a big difference in the end? Well, let's actually put some numbers to it and find out. All right, so check this out. We've got 3 traders, Jane, Bill, and Wanda. They all start with 10 grand, and they make the exact same 6 trades. 3 of them are winners, 3 are losers. The only difference, and I mean the only difference, is how well they time their exits on just those 3 winning trades. Bill's just a little bit better than Jane, and Wanda's just a little bit better than Bill. A tiny, tiny edge.
And the results, honestly, they're kind of nuts. Jane actually ends up losing a little money. Bill makes a small profit, which is okay, but Wanda, just by optimizing her exits a tiny bit, walks away with a 10.5% gain. That is a massive 13.4% difference between Jane and Wanda, all from squeezing just a little more juice out of only 3 trades. This is the power of the exit. And it leads to the obvious question, what's Wanda's secret?
Well, the answer is pretty cool. She threw out the rigid rules and the vague feelings. Instead, she used a different tool. Think of it like a compass, but one that's not based on her opinion or her emotions. It's based on the market's own language, volatility.
And this brings us to this one key idea, average true range, or ATR. Now, I know it sounds super technical, but stick with me because it's actually really simple. All it does is measure a stock's personality. It just answers the question, how much does this thing normally move in a day? And that is the key to figuring out what a reasonable profit target even looks like for that specific stock.
So once you start thinking in terms of volatility, you realize our old definition of an exit is kind of incomplete. It's not just about price anymore. You have to add time to the equation. The real goal is to get the biggest gain possible within a time frame that actually makes sense for your strategy.
And this is the really cool part. Once you have this volatility compass, you can start building an entire toolkit of smarter exit strategies. It's not about finding one single magic answer. It's about having a set of powerful, data-driven tactics that you can use when you need them.
So here's just a quick look at 5 of these tactics. Things like a relative exit, which tells you when a stock's move is getting a little stretched, or a PIV exit, which uses options data to find hidden targets. The point is, every single one of these replaces that gut feeling guesswork with a logical, repeatable process.
Let's just zoom in on one of these for a second. The PIV exit. What this tactic does is it uses information from the options market to pinpoint price levels where a stock is really likely to stall out. You can think of them like price magnets. So instead of just guessing where to sell, these levels give you clear, data-driven targets to aim for.
Okay, so this brings us all the way back to our train and our 3 passengers. We've seen all their mistakes. So, how do we become the ideal trader? How do we finally learn to get off the train at the right stop?
So here's the secret. The goal isn't to be just one of these passengers. The best trader is actually a disciplined mix of all 3. You need the confidence of passenger number 1, but with the humility to accept when you're wrong. You want the flexibility of passenger number 2, but it has to be guided by a solid process, not just random feelings. And you need to be data-driven like passenger number 3, but without becoming a robot and losing your creativity.
So after all of this, what's the one thing you should walk away with? Well, it all comes down to a single number.
1. That's it, just 1. Remember Wanda? Her entire incredible outperformance came from capturing, on average, just 1 more unit of average true range, just 1 more normal day's move on her winning trades. That's the whole game right there. That's the goal. It's simple, it's doable, and, as we've already seen, it can change everything.
You know, trying to navigate the stock market, it can feel absolutely chaotic, right? Everyone's got an opinion, a hot tip, some complex theory. So how in the world do you find the real signal in all that noise? Well, today, we're going to explore the market's very own early warning system. 2 incredibly powerful signals that can tell you when to be cautious and when it's time to get confident.
So, where does a question like that even come from? Well, it's from this great story about a legendary fisherman named Sam. See, his bank manager kept hearing about Sam's incredible success, and he just had to know the secret. So he finally convinced Sam to take him out on a fishing trip. What he saw next, he was definitely not prepared for.
You heard me, a hand grenade. Sam rows out to the middle of the lake, pulls the pin, and just tosses it overboard. And then, whump, a huge explosion, and dozens of fish just float right up to the surface. The bank manager, he's horrified. He starts yelling about how illegal and dangerous this is. And Sam? He just calmly lights a second grenade, hands it to the guy, and asks him that one famous question.
And that, right there, is the heart of the problem for us investors, isn't it? The market doesn't give a rip about our analysis or our feelings. It just makes these huge, explosive moves, and we're left sitting there shocked, arguing about whether it was fair or rational or whatever.
So, this brings us right back to that choice Sam gave his friend. When the market does something shocking, you can sit there and argue with reality, which, let's be honest, usually just leads to freezing up and losing money. Or you can learn how to fish. You can learn how to see the opportunity and, more importantly, how to act on it.
You know, instead of shelling out cash for some expensive and often pretty unreliable market timing newsletter, the source material here argues there's a much simpler way. The market itself is practically shouting its intentions. We just have to learn its language. And the best part? The data is totally free.
All right, so how do we actually do this? How do we listen in? Well, we do it by decoding something called market breadth. And this isn't about just staring at one index like the S&P 500. No, this is about listening to the collective voice of thousands of stocks, all at the same time.
Think of it like this. If you see the whole herd of stocks stampeding in one direction, that's a way stronger signal than just a few big names dragging an index up or down. Market breadth tells us what the entire army is doing, not just the generals. It's really the key to measuring the market's true internal health.
Okay, let's dive into the first of our 2 big signals. Think of this one as the market's blaring alarm bell, the warning siren that's telling you danger is dead ahead. It's called a correction event.
This is just a perfect analogy. When danger pops up, the entire herd just moves together, instantly. Most of those gazelles don't even see the lion. They just know they have to run faster than the guy next to them. A market correction is that exact same herd behavior. A massive, fear-driven sell-off.
And here's the really crucial part. This signal is designed to detect one emotion and one emotion only: immediate, widespread fear. On days like this, even the biggest institutional players can't hide what they're doing. Everyone is selling, and this event often acts as a warning shot that more selling is on the way.
And the best part is, you do not need a PhD in quantitative finance to figure this out. It's a dead simple ratio. You just take the number of stocks that went down that day and divide it by the total number of stocks traded.
That's it. It's a pure, unfiltered measurement of how many sellers there are compared to everyone else. Now, what's really cool here is you can actually see it in action. Look at that bottom pane. That's the ratio we just talked about. When it spikes above a certain critical level, in this case, 0.805, a little warning symbol, the skull and crossbones, pops up on the chart. That is literally the market screaming a warning right at you.
Okay, so if a correction is all about fear, what's the flip side? What's the signal for confidence? Well, that brings us to our second key indicator, the surge. This is the signal that helps us see when the fear is finally starting to fade and conviction is coming back.
A surge event is the exact opposite of a correction. It's an extreme, widespread buying day. And psychologically, it means the herd is kind of breathing a collective sigh of relief. Fear is going away, and buyers are finally stepping back in with some serious conviction, usually after a pretty big drop.
And guess what? The math is just as easy. We just flip the ratio on its head. Now we're using the number of advancing stocks as the numerator. This gives us a direct measurement of buying pressure across the whole market. Again, super simple to calculate, but incredibly powerful in what it tells us about market confidence.
This breaks it down perfectly. A correction is all about fear. It means more selling is probably coming, and it demands you to be quick and decisive. A surge, on the other hand, is about confidence. It suggests a bottom might be forming or a rally is continuing, but the key is the action. It requires patience. You have to wait for confirmation. Two sides of the same coin, but they demand totally different playbooks.
All right, so we've got these two amazing signals. Now for the big question. How do we actually use them to go from being the hunted gazelle to becoming the hunter? This is where we flip the script and turn that fear into an opportunity.
This is the absolute key strategic shift. When a correction hits and fear is everywhere, first you play defense, right? You protect your capital. But then you immediately go on offense. You become the lion, and you start hunting for the weakest stocks, the ones that were already trending down. After a surge, though, you're a different kind of lion. You're a patient lion. You stock the strong stocks. You wait for confirmation that the fear is really gone, and only then do you strike.
And look, this isn't just some nice story. There's real data behind this. After what's called a total correction signal, that's when this fear signal triggers on both the NYSE and the NASDAQ, the weakest stocks in the S&P 500 fell an average of 1.4% over the next 5 trading days. That might not sound like a lot, but it gives you a real actionable edge. Here's a perfect real-world example. Back on February 27, 2007, a market-wide correction signal flashed. A stock like Adeo, which you can see here was already technically weak and trending down, became a prime target for a short trade, basically a bet that its price would keep falling. The correction was the catalyst that pushed it significantly lower. This is that hunter strategy playing out right in front of you.
But the surge strategy, that requires a completely different mindset. You do not just jump in on the first hint of confidence. Why? Because market bottoms are messy. They often get retested. The strategy is to wait for a second surge signal to confirm the low. And while you're waiting, you're hunting. You're looking for those stocks that actually held up well during the decline. Those are your strongest targets once confidence is confirmed.
So what's the big takeaway here? The market isn't just this random, chaotic beast. It's constantly shouting its intentions through the collective action of thousands and thousands of stocks. By understanding these simple signals of fear and confidence, you can actually listen to what it's telling you. So the only question left is the one Sam asked his friend. Are you going to sit there and argue, or are you going to fish?
Welcome to The Explainer. Today we're going to dive deep into the art and the science of building a trading system from the ground up. We're going to take a masterclass on system design and turn it into a clear, actionable blueprint that'll help you spot those invisible patterns in the market.
Okay, let's kick things off with a comparison you probably weren't expecting. Think about your trading system not just as some piece of code, but as a personal work of art. The source material we're looking at makes this great point. It's a totally individual experience, and you are its only patron. You don't need to build something that works for everyone. It just has to work for you.
But here's the catch, right? This beautiful, personal creation of yours, it has to perform under some serious pressure. Military strategists call it the fog of war. For us, that's the chaos, the doubt, the sheer uncertainty of a live market. Your system has to be the tool that cuts right through that fog so you can act with calm and control when everything's on the line. So, the big question is, how do you build a tool that's both a piece of art and a precision instrument for war? Well, we're going to break it down. First up, we're going to talk about really nailing down your personal trading style. Then we'll shift gears into the scientific method for trading, turning those hunches into real hypotheses. After that, we'll get into why making your ideas visual is so critical. And finally, we'll wrap up with the most important step: test, don't guess.
First things first, before you can build anything, you need a blueprint. And this is the part where you have to be brutally honest with the client. And, in this case, the client is you. It's time to get super specific about what you actually want this thing to do.
Okay, so here's the absolute key. You have to lock these 3 things in before you even think about writing a line of code. I mean it, write them down. First, your time frame. Is it 2 to 5 days, a couple of weeks? Second, your objective. Be precise. Something like, I want to capture a swing of 2 times the average true range after a breakout. The ATR, as you know, is a measure of volatility, so that makes your goal really specific. And last, but maybe most important, you have to honestly ask yourself if this whole strategy actually fits you, your life, your personality.
And this is where you really have to ask yourself some tough questions. I mean, really. Does holding a trade for a week fit your day job? Can your personality actually handle the stress of this kind of trading? Is the risk profile something you're comfortable with? Answering these questions ensures you're building a system you can actually live with and trade without second-guessing yourself, not just something that looks good on a spreadsheet.
All right, so once you've got that personal blueprint, it's time to get disciplined. This is what separates a truly profitable system from just, expensive guesswork. It's all about taking a feeling you have about the market and turning it into something you can actually test.
You know that feeling, right? Chasing a hunch. It's probably the biggest trap any trader can fall into. But guess what? The antidote is a simple process, something we all learned back in science class, and it's incredibly powerful when you apply it to the markets.
It's as simple as this. You follow the scientific method. You start with an observation. You see something happening in the market. You form a hypothesis, a guess about why it's happening. Then you make a prediction, you run the experiment, and this is the crucial part, you analyze the results with zero emotion. This is your framework for finding a real sustainable edge.
Okay, now for the part I think is really cool. This is where things get exciting. We're going to take all those abstract mathematical ideas and make them tangible, something you can actually see and play with on your screen. Look, very few people on this planet can actually visualize complex math in their heads. For the rest of us mortals, visibility is everything. You absolutely have to see how your indicator is behaving in relation to price to really get the nuances and figure out how to make it better.
And you can see exactly what I mean right here. Just look at the difference. On the left, you've got your standard cramped monitor setup where the price chart is all squished, it's tough to see anything. But on the right, with that dual vertical setup, the price action has room to breathe, you've got space for all your components. That is a proper development environment.
And this is the end goal right here. This isn't just a chart with some squiggly lines. This is your thought process, laid out visually. Every single piece of your hypothesis, the regression slopes, the ATR calculations, it's all plotted out in its own pane. You can literally see how each piece of your idea interacts with price, which lets you spot what's working and what isn't instantly.
All right, so for our final step, once you've tweaked and refined your idea visually, it's time for the moment of truth. You've done the creative, artistic part. Now you step back and let the computer deliver the cold, hard, objective verdict.
And it's so important to get the order right here. You have to put the horse before the cart. Think of it like this. Visual analysis is the art. That's where you explore, you discover, you get your intuition. But we're human, right? We see what we want to see. That's why you need the backtesting, the science to come in afterwards and give you the objective truth. View the charts first, backtest second, every time.
So, does this whole process actually work? Well, in the case study we're looking at, the answer is a big yes. The new component they built showed a clear, measured improvement. That key metric, the profit-to-loss potential, it improved by a delta of 8.5%. Okay, let's actually dig into these numbers for a second, because this is pretty interesting. The new system's profit potential jumped by almost 40%. Now, yeah, its loss potential also went up a bit, but the key metric, that overall profit/loss delta, still showed that awesome 8.5% improvement. But here's the kicker. It also generated 48% more trade signals. Getting better performance with way more opportunities? That's a huge, huge win in system design.
So what's the big takeaway from all this? Building a trading tool is a deeply personal, creative act. It's art, but it absolutely has to be grounded in a disciplined, scientific process. By making your ideas visible and then testing them objectively, you can build tools that let you detect the invisible. Those subtle little market inefficiencies that all the generic, off-the-shelf stuff will always miss.